so much, Shirin. It's such a valuable content you shared. Really, thank you for that. Because some of the things are like completely new to me, like why we are buying our investment properties under the company name. I mean, I didn't went so deeply, but really thank you for that insight. Thank you. So yeah, so guys, please come up and ask the questions. Here is your opportunity to ask what you want.
Yeah, and any questions, guys? It could be anything, and no question is a silly question.
Yeah, yeah. So guys, we only have 15 to 20 minutes for the question and answer session. So yeah, let's fire them. Yeah, guys. And Shirin, I have a questions actually. So people are still, I think, thinking their questions. So I have some questions for you, if you don't mind.
Yeah, sure.
Yeah, so basically, we have our residential property, and we now buying our investment assets under the company name. So we have our asset holding company. So in future, if we decide to move our residential home under that asset holding company, and if we want to go ahead for the another property as a residential home, so can we do that, and how easy the procedure is?
So just to clarify, you have a residential mortgage and you are looking to purchase another residential mortgage. So you're looking to port, or are you looking to sell and buy, or sorry, if you could explain that again.
Yes, so we actually want it as giving to letting. So we want this as a buy to let.
Sure. Yeah. So you would. Yeah. Okay. I'm seeing a lot of that at the moment, and it typically is in higher taxpayers. So they don't want to sell their current property; they want to keep it. And what would happen is you would sell to your limited company. Now there is still a sale and a purchase. It's not sort of remortgage and then you convert it into a let to buy or a buy to let. It is a sale to your limited company. So you would incur, the capital gains tax, you would incur stamp duty, but it is a sale to the limited company, and that limited company will then own that property. But in terms of deposits, if you're looking to do like for like, then there's no money exchanging hands, and lenders are comfortable with that. But I'm doing a lot of that, whereby people own properties in a personal name and they're trying to convert it into a limited company and retain it. So is that the question and the answer that you're looking at?
Yeah. Yes. Okay.
I would like to add something more on that question too, Parinita just asked. So in the same scenario, if I have my own property, residential property, and I invest on some buy-to-let or the HMO property, and in future, I invested. My investment property is under the limited company. In future, I wanted to sell my personal or residential property and buy another property. Okay, and if I do that under personal mortgage or anything, how it would impact on capital gain tax, and how it would impact on getting the mortgage or the interest on mortgage.
Sure. So I'm not a tax advisor, so my limited knowledge on the capital tax element is if it's your primary residence, if you're selling and then buying, the CGT is based on whatever the gain that you've made. But there is calculators on .gov websites where you can literally put in, the price that you bought, the cost incurred, and at the end it will give you a sort of a figure in terms of whether there is any tax due. But if I'm correct, I mean, if it's your primary residence, there is no capital gains tax. But again, like I said, I'm not a tax advisor, so it's not one of those questions I can answer, I'm afraid.
Okay, but how it would impact on mortgage, because I already have a property under my limited company?
So the question I guess you're asking is about stamp duty. Yeah. So with stamp duty is it's determined on whether you're actually selling your main residence and buying it. So there's three brackets. One is a first-time buyer. Second, if you're a home mover, and then third, if you're an additional property owner. So if you're a home mover, by selling and buying, again, there's a calculator online, and I could probably share you the actual website, but it's a really good one because you literally just put in the amount that you're looking to purchase at, and it will calculate as a home mover what your stamp duty is. But there will still be stamp duty, but it would be reduced in comparison to you buying, let's say, for example, you were keeping that property residential and you were buying another buy-to-let. So therefore you own two properties. That's what you call an additional homeowner. And that's where the additional stamp duty applies.
Okay, I understand that it will impact on getting the mortgage or the mortgage interest from the lender as well.
Sorry, what do you mean by mortgage interest?
So if I'm buying a new property as a residential property, and at the same time I have my investment property under the limited company, how they go hand in hand together?
So just to clarify your example, you have your main residence, you have your limited company, and you're looking to buy a third property?
Mm-hmm.
Yeah, so, and sorry, your question is what implication that has on stamp duty?
Not really on the stamp duty, it's just getting the mortgage, because I'm selling my own residential property and buying another residential property. So I'm not having two properties under my name. I'm just buying a new property where I'm going to live. So is it counted as the first property, and the mortgage?
It's just a home mover. It's just a home mover. You're selling your main residence and you're buying another. So it's just a home mover. So yeah, in terms of stamp duty, as I said, there's websites online which will give you what the stamp duty figure is. But from the eyes of a mortgage lender, that's quite normal in what you're looking to do.
Okay, thanks.
Sorry, I don't know if that's answered your question, but yeah, again, I'm not a tax advisor. So a lot of these questions about capital gains, stamp duty, they're all dependent on the sale. So for example, with the stamp duty, normally it's something your solicitor will be dealing with. Your solicitor, as part of that transaction, will be completing the SDLT form at the end of the transaction. So my advice would be to ask that question to the solicitor, because they will be the ones that will be doing that return and informing HMRC of what stamp duty is payable. But again, there are websites online that you could go on to, which will give you the figures that you're looking for. And equally with CGT, again, there are websites online where you could calculate if there is any CGT on both residential and buy-to-let properties.
Right, okay, cool.
Hi, Shirin.
Okay,
Thank you for that
you.
great
No
insight.
problem. Hi, Mark. How you doing?
Yeah, not too bad, thank you. I think you've wiped out a few of my questions in your response to the other one, because you mentioned you're not a tax advisor, but I still do have a few more questions. You mentioned about being a portfolio landlord. If you have four more mortgage buy-to-lets, why do lenders scrutinize you more? Surely they'll see you as more experienced, therefore more likely to lend to you. Because let's say I've not got any buy-to-lets, I haven't got any experience in managing buy-to-lets. Surely I'm more risky than someone who actually has experience.
Yeah, so the risk element and the experience elements, I think, are two different things. So experience is very, very good and important for lenders, and they definitely take that into account. So for example, you know, there are very few lenders that would allow anybody to go and do a HMO, because the HMO requires experience. You know, you've got managing multiple individuals. You need, you know, to make sure the property is up to the right standard. You need to understand selective and licensing, and whether that area needs that licensing. It might need a rejig of the property internally to make sure it fits the local authority's criteria. So with that, a lender wanting someone that's got experience is very, very important. But likewise, on the risk side of things, you could have, I mean, I had a case where I had a client that had 50 properties, and I took it to a high street lender. But the lender looked at it as, well, the guy's got too many properties. And what they look at is, you know, how many properties you have, the rent that's coming in for those properties. They stress the properties in the background, because what they don't want, as I said in my presentation, is for the market to turn And what you then find is if the market turns, and that could be turning in terms of interest rate rises, it could be rental voids, and we have had that where, you know, tenants were not paying rent, you know, and there were rent voids, and we've had a situation where evicting tenants was put on hold by the government, where you couldn't evict tenants. So that's all risk. So by having multiple properties, that's multiple risk, and lenders look at that very, very closely, because what they don't want is someone highly geared. So they've maxed out the borrowing at 75%. The rental income is just meeting the portfolio stress test, and it could be a problem if interest rate rised, or it could be a problem if one or two properties rent were not being received. So you do add an element of risk, but not to say the experience doesn't help. But you need a blend of both in order for the lender to be happy with it. There are some lenders that have got a bigger appetite for those lenders that have multiple properties or are highly geared, but equally there's a higher interest rate for that. But if you are a vanilla client, then I'm sure any lender will would want your business. So if you were, let's say, at 30-40% loan to value, then most lenders would accept your business. So I hope that answers the question around why experience and risk is equally important for a lender.
Yeah, no, thank you. That really makes sense. I don't know if I have time, but I have a few more questions.
Yeah.
You talked about where is it? Got so many notes written down about debt, and you said you should have good debt to credit. Now, usually online you see stuff about 25% credit utilization. Now, do they talk about, when you talk about debt, are you talking about like mortgages, or you talk about more consumer debt? So I don't know, cars, credit cards. What kind of debt are you talking about?
Yeah, I'm talking about unsecured lending, so credit cards, loans, those kind of things, because lenders also don't like a high debt to income ratio. They feel a bit nervy in seeing that customers have taken out a lot of debt. And again, it goes down to a number of things. I mean, we're seeing right now inflation. If inflation increases, that has a knock-on effect on your disposable income. Again, if you've got a habit of borrowing money, well, there could be a perception that you may continue borrowing money, and there might be a reason behind that as to why you're continuing taking on more debt. So all of these factors a lender looks into to understanding whether there is a risk to the bank that if they lent to you, that you could potentially take on more debt and you land yourself in trouble whereby they don't want to have a borrower that's already at high levels and take that risk. So that makes a difference. And I'm talking more about buy-to-lets than residentials here. But residentials, I mean, I think it's easy to know that obviously a high debt to income ratio just means that the mortgage won't be affordable. And there's a pattern of maybe borrowing. And equally, again, they also look at how you've taken on that debt. So if in a year you've taken on 10,000, 20, 30, 40, so in a quick succession, if you've taken on all this debt, that's also what they're looking at, compared to maybe over 3 or 4 years. So hopefully that's answered your question.
Okay, I'll do one more. Don't take much time. I mentioned you kind of wiped out all my questions because about tax. So do you have any books you'd recommend about tax, like capital gains tax, anything, or any tool to learn more about tax?
I don't know, I'm afraid. I think Mohammed is Mo's a bigger reader than I am. I mean, I do follow sort of podcasts and portals and stuff like that where it does give you insight into that. But there is one about SaaS, which I think, I mean, it may not relate to a lot of you, but it may relate to some people that are limited company owners, because it's a way of investing into commercial properties, whereby your SIP or SaaS is investing, it's an interesting type of investment. But again, if there are any limited company or sole traders out there, I definitely say read more about SIP or SaaS. It's a great way of investing. But sorry, I don't have any recommendations for CGT or stamp duty.
Oh, good, thank you.
Thank you so much, Mark. Do you have any more questions, Mark? No, but that's good. Thank you so much. It's really valuable, and thank you for asking those questions. I think we have some more questions from Manu. So Manu, you can unmute and ask.
Hi, Manu. Hi.
Hi, Shirin. Hey, how are you?
Yeah, good. Thank you. Yourself?
I am good, thanks. Yeah. I mean, they mentioned about Portify is something new to me regarding building credit score and stuff. So, in terms of getting mortgages, obviously the lender looks into the credit score.
Yeah.
But my question is, in terms of establishing a limited company, but not the sole owner of it. Say there are like 3 people who is owning the limited company.
Yeah.
And 3 of them have like is a hypothetical situation. So 3 of them have like average credit score, and say that the mortgage goes through, like for the buy to let, and we happen to put in the money, all 3 of us, but not equal share maybe, and say the mortgage goes through, we secure the buy to let and stuff, but in terms of running that project further on, say one of the partners says, I want the share back and gonna split. How does that impact on the credit score and stuff?
It's an application. So I guess if I'm correct in your question, if someone wants to take their money and they want to leave that sort of investment, so you've gone from 3 to 2, obviously a lender would need to be notified, because they would have been added on as a shareholder and a director, and there would be an application as such, or at least some sort of underwriting to make sure that the remaining 2, and in terms of the actual mortgage, it's still they fit the criteria of the lender. And that could be a criteria of income, that could be a criteria of portfolio, it could be a number of things, but you just need to notify a lender. It happens a lot, and it happens on residentials and buy-to-lets where, one person wants to come off, or you've had a separation, or you've had a divorce, or you've had, the partnership is dissolved and you kind of want to split your ways. One person wants to buy out the other person. So it's all possible. It just means that, it's a reassessment of the application by the lender. And on that point, I would like to say that, 1, 2, 3, or 4 even shareholders and directors, you could do on a limited company purchase. I mean, there are some lenders that even, go up to 5 or 6. You could also do whereby you've got an individual and a company as a shareholder. So there's, with limited companies, depending on what scale you're at, there's various different ways of structuring it, and that all comes down to your discussions with your accountant, your discussions of what your plans are, because with limited companies you can have a number, or you can have a holding company, and that holding company is effectively wanting to invest and JV with somebody else. So yeah, I hopefully that's answered your question. But yeah, there's many things that you could do, and you can reassess. So there is no limitations on that.
Cool. Okay. The other thing regarding credits, because I wasn't too clear, was like you said to close down unused accounts.
Yeah.
So is that in terms of credit cards or like?
Yeah, so credit cards, unsecured lending. So credit cards or loans, I mean, generally speaking, it's normally going to be credit cards. And those are, sometimes when you balance transfer and then you've paid it off, and then you realize that actually that lender's come back to you and said, oh, we've given you a bigger credit limit, and you don't, or you failed to close that account down, and you've set up or balance transferred it to another lender. So those are sort of the scenarios that I can think of where customers have forgotten about these other credit cards and limits that they have. And also, if you've got a credit card limit and you're not using it, especially when you're taking out a mortgage, think about it, because, the higher the credit limits, the more credit is available, and lenders do look at that.
Right. Okay. So in terms of, say, having current accounts and say 2, 3 different banks, that's okay. It's just a credit
Yeah,
card. That's it.
yeah. Current accounts are fine. It's just credit cards. So before you're applying for a mortgage, just consider, how many credit cards you have, and if there are unused credit cards, just remove them. Call up the bank and just cancel them. They will take about a month to update on your credit report. So again, it's something I would advise at least a couple of months before. I'd always say review your credit file at least a month or two before you're applying for a mortgage, because there are situations where things that you don't even know about, you realize, and I've seen it a lot of times.
Right. So yeah, I mean, you have worked with Barclays, and my first bank is Barclays, and the reason I was talking about credit cards is because one of the employee there, when I approached them for having a personal loan out, they've advised me that the limit that they can give the loan at the moment is like £8,000, and the interest rate would be like 24%. And so, no, I'm not happy with that. So the advice is like, get a Barclays card and start purchasing and paying it off, so that the bank sees that you're credible in terms of getting loans and paying it off. And that kind of helps. So I had a notion that the more credit cards you have, the more purchases and
that matters. Yeah, that matters when you're trying to get credit. It's almost like lending money. If I lent you money and you've paid it back on time, I know that actually, Manu, you're a credible person now. So if I'll lend you more this time, potentially because I can earn more interest. But there's an element of understanding the credibility of somebody, and the banks. I guess the way that works is by looking at your financial history. So that the advice of that person might have been because at the moment we don't know, or you're new to bank, or there's not been years of history. So the more you the more you borrow, the more you pay back on time. That's how you build it up. And it's the same thing with mortgages. With credit history, that's so important. And you might get that when you're new to this country. You get that a lot with anyone that's new to this country, that there's not enough credit. It also can work the other way around, where if you're against borrowing money, which some people are, there's not much active credit for someone to then look at and say, well, actually, do you know what? There is not much credit history on this person. I don't know whether they have got the experience of paying it back, but yet they may be the best because they've never borrowed money. So it's a fine balance in that. And it's just, there's always this perception that you do need to have credit cards, use it, and build up your credit history. And like I said, that website there would definitely help you with that.
Cool. And in terms of current accounts, there was a senior person who told me, like, maintain a current account that shows like income and minimum kind of expenditure. So I have like 2 different current accounts in 2 different banks. So I get the income on one, I transfer a certain amount of money to the other account and spend it off from the other account. So the way the bank statements look on the ones that I get income is like very minimal transactions, and the one that I spend from have like 3 or 4 pages of activity on. Does that help, or is that just a myth?
It's a myth. I mean, you can structure your banking in many ways. Some people have savings going into another account as a savings account, and some people have credit cards that they use just for expenses because of the points that you accumulate. So it's really up to you how you do that. But all of that would be built into your credit file, and that's what banks look at. So if it's more about your credit score and everything else, it's a myth about how you use your banking or your current accounts. It's all about your credit score. So it's borrowing, paying it back on time, and doing the other bits, and registering to vote, and the other stuff that I explained in the presentation. But as I said, that website is really good at helping you do that.
Cool. Thanks, Shirin. Thanks for clearing all that. Thanks. Yeah.
Thank you so much, Manu. Thank you so much, Shirin. It's really helpful.
Okay, no problem.
We got one more question on chat. It's saying, is it possible to get interest-free mortgage on the residential property?
Yes. So not interest-free. I'm not sure if you can get that. But I think the question was more about interest only.
Interest only. Sorry, I just read it wrong.
That's okay, no problem. So yeah, interest only, definitely. There is criteria around that. Obviously, it depends on which lender we go with, but the answer is yes. Generally speaking, most lenders want, you know, a good level of income, whether that's 75,000 sole or joint 100. With some lenders, there's just no minimum. All of them will want some sort of suitable repayment vehicle. So how will you repay this money back? So we would then have ask questions with the customer, whether they've got endowment policies, if there's selling of the property or another property, or if it's stocks and shares ISAs. So there's got to be some way of repaying that back. And also what banks do sometimes look at is equity. So they've got to be a sufficient amount of equity in the property as well. But there's a number of factors which determine whether you can get an interest-only mortgage. But it will be on a case-by-case basis. So but the answer is yes, you can.
Thank you so much, Shirin.
That's okay.
So Shirin, I have got a question leading on to that. It is a quick one. So can we change a repayment mortgage to an interest-only mortgage? How easy is that?
Yeah, it's easy as long as you fit the criteria. So I have a lot of customers that buy properties, but I mean, see, look, I think with interest only, if I'm being honest, on a residential, generally you tend to see that with higher rate taxpayers, because they want to keep the disposable income low. Obviously, where if you're borrowing £1 million and your payments maybe about £3,000–4,000, that's going to be a high disposable income. So their attitude to repaying that back is to keep, you know, payments low, because they want the disposable income to travel, to pay for school fees, or it could be just for extra disposable income to invest. And their repayment vehicle is to, you know, they'll downsize and sell that property at the end of the term and repay that back. Some choose to do part and part. You don't generally just have to have interest only. You could do part repayment and part interest only. But it comes down to having that conversation with the customer and understanding what their needs are. You know, a lot of the time, those that do want interest only is because they want the mortgage to be a certain amount. And there's obviously reasons off that. It could be saving a bit of money for buying another buy-to-let, you know, saving for kids' part for education. It could be a number of reasons. And we sit down and understand that, and then tailor that to what you want, and what the right product is. So our sort of, you know, advice is based on collectively understanding why you want interest only. So yeah, you can is the answer.
Thank you.
Yes, anybody has any questions? If not, then we can move ahead with our next session. But yes, thank you so much, Shirin. It's such a valuable.
My pleasure. Thank you for having me. And you know, I please do share my contact details. I think they are available, or if you do need them, please let me know. Feel free to give me a call. We have a team of brokers who can help you with any query, whether that's purchasing a buy-to-let property for the first time, or whether you've got a portfolio of properties, or even whether you're looking at buying a property through an auction, or looking for bridging finance. So there's an array of kind of lending that we offer. So feel free to contact us if you have any further questions. But thank you for your time, and hope this has been helpful to everyone that's watching. Thank you.
It is definitely, Shirin. Thank you so much.